Hi, and welcome to our end of February update from the Wealthy Doctor Institute, Intelligent Investing for the Busy Professional. We focus on simple battle-tested methods of investing that require just a few adjustments per year to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in the book are easy to calculate and adjust each month, for those who are new to the concepts of this book, or for those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month and to get the hang of it. So this month, rather than talking about a topic of the month, there have been several people with questions on how SectorSurfer works or how to follow along with SectorSurfer, so we'll concentrate on that this month. Meanwhile, we'll take a look at the 20-month moving average system and other ways of determining when markets are relatively safe or dangerous. Then we'll look at the MRI system, or sector rotation systems in general. Then we'll remind ourselves of the rules for the 25% trailing stop loss system. Then we'll remind you about SectorSurfer strategies. So remember, these are systems. Rather than trying to speculate or forecast or predict what markets will do, what we do is we let our systems objectively look at the footprints of every trader and investor in the markets and let the markets tell us what to do through the lens of our systems. So the first system is the 20-month simple moving average system, abbreviated to 20-month SMA, as in my book. So rules of the 20-month moving average system is simple. If the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay invested in the index fund, otherwise get out. The 20-month moving average is our safety belt. It only works if we watch it every month. So here's our updated chart. As of end of February, the VFI index, which is the Vanguard S&P 500 index fund, ended at 218.80 per share, which zoomed up ahead compared to the 20-month moving average, which was only 191.85 per share. So we take a look to 1880 over 191.85. We have a comfortable 14% cushion. In other words, if the index wiggles around in the next month, as long as it stays above this 20-month moving average, in other words, if it doesn't fall more than 14% in the next month, the system indicates that we're relatively safe to be in the markets for now. So observations for this particular system for this month: the 20-month moving average continues to signal relative safety in the US stock market, and even though there's a nice healthy 14% cushion between the fund and the 20-month moving average, remember that stocks go up and stocks go down. There is a reversion to the mean. In other words, stocks can go down, but as long as it goes down but still stays above the 20-month moving average, it's still relatively safe to be in the markets. That's why we check this once a month. This system is not designed to catch peaks. Markets must fall enough for a system to fulfill the criteria for a danger zone before we get out. So here's SectorSurfer's Storm Guard Armor, the SectorSurfer analog to the 20-month moving average. Both the Storm Guard Armor and the 20-month moving average are indicators to see whether or not the stock market is relatively safe or dangerous to be invested in right now. So for instance, if we're looking at whether or not it's relatively safe to be in stocks, yes it is. The white line is the S&P 500 index. The red line is the S&P 500 mutual fund, and the yellow line is all the same line. That means we've been in stock for the last month. So the next system is the monthly rotation investment system, abbreviated to MRI in the book. It's actually just a special instance of sector rotation, and when we say sector rotation, we actually mean any type of fund or ETF, or just rotating between a group of investable vehicles that are ideally not well correlated with each other, so we can capitalize on dominant trends as they arise. Rotation systems originally started with sectors of the economy, hence the name sector rotation. We do not necessarily have to use sectors, and in this case, we're using three distinct mutual funds: the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. These aren't technically sectors, however, they are three funds that are not well correlated with each other, and therefore it is relatively easy to detect dominant trends as we compare them to each other. So with the old MRI rules, every month rank these three particular funds and then sell the bottom 25% of your portfolio and buy the top fund. Repeat each month. So here's this month's ranking. Last month, the prices of the S&P 500 Index Fund, Emerging Markets Fund, and the Inverse Fund were so. This month, we can see that the S&P 500 Index went up 3.96%, the Emerging Markets went up 3.28%, and the Inverse Fund lost 3.81%. Now, you can see graphically that during the month, for the most part, the emerging markets were outperforming the S&P 500 index. However, within the last week, the emerging markets started to weaken. So, with the current model, remember last month, we were roughly 75% in the emerging markets, 25% in the index fund. This month, we sell the lowest 25%, which is the emerging markets, and buy the S&P 500 index, so we're roughly 50% emerging markets index fund. So here's how SectorSurfer would rotate these three particular funds. Notice that we turned off StormGuard Armor since the inverse fund is itself its own bear market strategy. By definition, if there's an S&P 500 index and an inverse fund in the mix, something by definition is always going up. And over here in the graph you can see the mirror image. The white line is S&P 500 index, the red line is the S&P 500 index fund, and the yellow line, which is obscured by both the white and red line, is where we've been in the last month. And you take a look at the blue line, that's the inverse fund. When stocks go down, blue line goes up. When stocks go up, blue line goes down, etc., etc. And the green line is the emerging markets fund. So if you were to have used SectorSurfer on those three particular funds, you would have been 100% in the S&P 500 index fund. So observations of the month: the emerging markets were again showing signs of strength until about a week ago. SectorSurfer still has not triggered any switch from the S&P 500 index fund. Remember, SectorSurfer uses a different algorithm. It doesn't rotate a quarter of the portfolio at a time, it rotates 100% of the portfolio at the time. So don't mix up the systems. Now to go on to other systems that we monitor: the percent trailing stop system for individual stocks, and tips on how to monitor your own SectorSurfer strategies. So the 25% trailing stop system is when you absolutely positively want to hold individual stocks for some strange reason. If you really want to buy a stock, remember each stock has idiosyncratic risk. In other words, stock-specific news can come out overnight and tank the stock the next day. So if you want to limit your risk to any one stock, don't risk more than 1% of your portfolio on any one stock. And the way you do this is, if you have a 25% trailing stop loss, you can buy up to 4% of your trading account in that one stock. This way, if it falls 25% of 4% is 1%. At most, you lose 1% unless it really gaps down far below your trailing stop loss. And if the stock goes up 33%, feel free to buy another block of stock using 4% of your account, because remember, if the stock goes up 33%, If it goes down 25% from there, then you've hit your stop loss, which happens to be your break-even point. Remember, if you lose 25%, you need to make 33% just to break even. Same thing happens on the upside. And keep repeating this until you're stopped out. Now our next system, use your own SectorSurfer system. SectorSurfer is a great way of improving on the classic pie chart investing if structured correctly. So SectorSurfer has two main tools. It uses Storm Guard Armor, which is a way of determining whether or not the stock market is relatively safe or dangerous to be invested, and then during the bull market phase or the bear market phase, we can use sector rotation strategies to help optimize possible choices to use during those particular phases of the markets. So it's kind of like combining my 20-month moving average and MRI, only slightly more robust algorithms. And with SectorSurfer, you don't trade nearly as much as the MRI system. So here's the example pie chart we've been following. This particular pie chart is the Swensen model that Tony Robbins describes in his book Money Master Game, page 329. It consists of total stock market index, real estate, total international stock, emerging markets, inflation protected bonds, and long-term treasury bonds. Now this is how the pie chart fared last month. If you take a look at all these different components, the yellow line is what we did last month. So while the S&P 500 index went up 3.3%, if we include this one extra day here in January, then the yellow line went up 2.1%. And once again, you see how there are 4 funds above and 3 funds below. So it does average of this pie chart, even though we're weighted more in certain funds than other funds. It goes to show how average a pie chart actually performs. Now if you take a look at if we were to SectorSurfer the Swensen portfolio, in other words, during bull markets we choose among one of these 4 stock funds, and during bear markets we choose one of the 2 bond funds, you can see that for this past month, even though the S&P 500 index went up 3.26%, again including those extra days in January, we were actually in the emerging markets fund, which did do better until around a week ago when the emerging markets started to go down faster than the S&P 500 index. Now remember, this SectorSurfer strategy only trades maybe 3 times per year. It's not designed to pick every top and pick the definite winners. It only picks the highest probability winner based on market trends after we strip out as much of the noise as we can. Now as of publication today, this is February 28, SectorSurfer still has not met criteria to say that emerging markets has weakened enough that some other fund would be considered strong enough to take over. And in fact, with SectorSurfer, this particular system has been in the emerging markets since December 1st. So since December 1st, the emerging markets has returned 8.7%, whereas the S&P 500 only returned 8.04%, with no further trades triggered so far. Now, a caveat. If you've been following this on the videos, this does not mean that you should go buy emerging markets now if you have not yet started this particular system. This signal is old. It started back in December. So the new signal can change at any moment. So if you have not started this or some other SectorSurfer strategy yet, I would hold on and not pull the trigger until the new signal comes out. And just for comparison, here is the pie chart model over the same 3-month period. Again, here's the yellow line where the pie chart is. It's kind of like in the middle between all these funds, bringing only 6.04% compared to 8.04% of the S&P 500 index. So with SectorSurfer.com, if a SectorSurfer strategy is set up properly, you will get a signal through email or text. However, if you're anal like I am, log in periodically, like for instance once a month, or maybe even once a week, to make sure you do not have a trade signal that's pending that somehow you missed. So for this month, StormGuard Armor says that it's relatively safe to be in stocks, and then SectorSurfer said, okay, if we're in the bull market phase, let's choose one of the stock funds, in which case it chose the emerging market stock fund as the stock fund of choice on December 1st. So in summary, we've gone over several systems, each one with a different risk mitigation strategy. And remember, these are all different systems. Don't mix the systems up. The one exception would be SectorSurfer. SectorSurfer is built to be combined with StormGuard Armor. But otherwise, we went over the 20-month moving average system, the monthly rotation investment system, dealing with stock tips, and to remind yourselves to monitor your SectorSurfer strategies. So keep those questions coming. I know I talk to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague. Here are ways to get in touch with me. Seriously, drop me a line, give me a call, email me, set up a consult. A few of you I've talked to, you know your stuff, I know you're fine. But for some of you, it's clear that you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.